All right, now let's talk about tutorial questions. This is the first question, chapter 1, problem 1. What is the most important difference between a corporation and all other organization forms? Well, apart from the taking different names, there are a number of differences, key differences. Well, first of all, a corporation is a legal entity separate from its owners, which means shares, which is the ownership, represent the ownership in the company, can be freely traded. Anyone can be the owner of the company, and well, no other organization forms actually share this characteristic with Pond did. And investors can be anonymous from any background, and there is no limit as to how many owners a corporation can have. And so, if you think about sole trader, how many owners can you have in the sole trader?
One.
You know, minimum 1 and maximum 1. Yeah, for partnership that would be minimum 2. And can you think about any other differences that come across your mind?
Yeah, well, I mean, another big point is that because it's a separate legal entity, it means that it enters into contracts itself. So when a company enters into this contract, it's not the individual, like an individual in a sole trader or a partner in a partnership entering into a contract. It's actually the company itself entering into the contract, which is where we started to distinguish between this limited liability and unlimited liability, because it's this company that's entering into these contracts means that, you know, if something goes wrong, then anyone that we owe money to can't essentially come to us and try and seize our assets to repay what's owed.
Correct.
But to your point of the anonymity and essentially anyone can be a shareholder, do you think that makes raising capital, so when the company needs to invest in a new project or it's trying to expand, grow, or whatever it is, and it sells shares, do you think that makes it a lot easier for companies to raise capital? Because essentially anyone can own it without, you know, it doesn't matter what their educational background is, it doesn't matter where they're living or anything like that. It's just anybody who's willing to give this company money can.
Of course,
right?
Of course.
Yeah.
But when it comes to a block holding, for example, when you're holding the shares exceed certain amount of the company that start taking control of the company, then the government agency may actually step in, or the regulators may come and step in to say whether that would violate any security conditions. For example, you know, let's say if you're a Chinese company that you want to take over another US company that working telecommunication service, then that may violate some sort of certain security conditions in US. So that kind of takeover may not be approved by the regulators. So in that case, investors. So not everyone can be not everyone can be the block investors in this case. So but this definition applies in the general sense.
Yeah. Cool.
Let me just quickly share so here is something very interesting. This is again our discussion forum 1, questions related to lecture materials. So there were a number of threads that I think is quite relevant to students this year, which were asked by students from last year. The first one is company versus firm. So I think a student asked from last year saying, what is the difference in the term company and firm? Because Daniel or I tend to use them interchangeably. And here, if you want to read about it, I'm more than encouraged to read about company and firm. But in fact, a corporation is not legally defined in Australia. When we talk about business forms, there are only company, not corporations. Here's another one. And if you want to learn more about limited partners versus board of directors and shareholders, here's actually a very interesting thread. And feel free to read it. If you have more questions related to it, definitely feel free to ask that. Okay, now let's look at tutorial question number 2, which is chapter 1, problem 6. You are a shareholder in an Australian corporation. The corporation earns $2 per share before taxes. Once it has paid taxes, it will distribute the rest of its earnings to you as a dividend. The corporate tax rate is 30% and you are on the lowest tax rate of 19%. How much is left for you after all taxes are paid? refunded. All right. So now let's go to the Daniel side.
What's the first thing we need to do? Well, we need to see how much the company has made. So how much has the company made in its earnings and how much is it going to be taxed on those earnings? So it's made $2 per share, which is just an earnings figure, that's all. So what we have to work out is how much does the company essentially distribute to its shareholders? So the company is going to pay 30% tax, and then it's going to distribute that entire dividend or that whatever's left over to its shareholders. So we have the $2 per share. And now what we want to do is that we want to work out how much is left over. So what we have is that we have 1 minus the company's tax rate of 30%. Right? So all this is saying is that what the company is going to pay out to its shareholders is essentially 70% of this $2 earnings per share. And that will give you $1.40. So what we can see here is that the company has essentially paid 60 cents in tax. So the difference between the $2 before tax and the $1.40 after tax is the 60 cents that the company has paid in company tax. So that's gone to the tax office. So in the question, we're told that we're only supposed to be paying 19% tax. So as the investor, I have a marginal tax rate of 19%. So we need to work out how much tax I'm supposed to pay and how much I'm going to be left over at the end after paying back this tax.
Correct.
So how do we go about doing that, Frank? What's the first step we should do?
Well, we should work out how much dividend we're actually receiving and what is the total taxable income that we have to pay.
So the dividend that we received was $1.40. And then we learned about this imputation credit.
Mm-hmm.
What was the imputation credit?
Which is the 60 cents?
Yep. So that's what essentially the company has paid in tax. So that was, and now we're going to calculate how much we're going to pay on tax based on the grossed up amount. So we add our dividend that we've been paid by the company and our imputation tax credit or our franking credit, and that will give us the $2. So we're going to calculate the amount of tax that we're supposed to pay based on this $2. So the amount of tax we're going to pay is $2, which is our grossed up amount, multiplied by our tax rate of 19%. And that's going to say, well, we should be paying 38 cents in tax per share. That's what we should be paying. Is that right?
Mm-hmm.
Cool. All right. So that's what we should be paying. How much has the company actually paid?
60 cents.
It paid 60 cents. So, well, it seems like as a shareholder, I've paid too much tax.
Mm-hmm.
So we can use this imputation tax credit here of 60 cents to offset the tax that we're supposed to pay the tax office of 38 cents.
Mm-hmm.
So what do we do to work that out? So what we're going to do now is that we're going to determine how much the individual should pay in tax. So we're going to deduct the franking credit of 60 cents. The franking credit of 60 cents from the tax that we should have paid of 38 cents.
Mm-hmm.
So the tax paid will be our tax that we owe the tax office minus our franking credit. Can
Correct.
you see that okay?
That's right. 0.38 minus 0.60.
Cool. So that means that we actually have a negative number. What does that negative number mean, Frank?
Well, that means it will be a money coming back to you. So if you pay a negative price, that means will be an income, will be an inflow back to your pocket.
So remember that we're actually calculating the tax paid here. So essentially that negative number, we've paid too much tax, so the tax office is going to give us 22 cents per share as a refund. Cool. You happy with that?
Yep.
So how much tax has essentially been paid in this scenario? Well, what we're left with, at the end of the day, what we're left with in our bank account, after we've gone through all of this, what we're left in our bank account is this $1.40 that the company gave us in the dividend and the tax refund that the tax office gave us. That's what we're left with. So in our bank account, we have, so how do I write this to determine the amount of tax to be paid? No, where is it? Oh, the amount left. Okay. So the amount of the dividend left is equal to our $1.60 that the company gave us plus the refund from the tax office. Oh no, sorry, it wasn't $1.60.
Correct, 140.
40. Yeah. So the $1.40 in dividend from the company, the 22 cents from the tax office. So we are left with $1.62 in the bank.
Correct.
So at the end of the day, how much tax have we actually paid? Well, we've actually paid the difference between the initial $2. Can you still see this too?
Yes.
So the initial $2 that we received minus what we end up with in our bank account.
That's right.
So tax paid is equal to the $2 minus the $1.62, which is equal to 38 cents.
That's right.
Right? So now having a look at that, I'm running out of room here, we can essentially say that our effective tax rate in this circumstance was
19%, which is your personal tax rate.
Yeah.
So which means mathematically, you would say after all this calculation, the tax rate that you'll be receiving is essentially your personal tax rate. But the whole process actually goes from this way: that you get paid dividend $1.40, and you get paid a credit with 60 cents. That is a tax credit, and then in this case, your total taxable income will be the $2. Which means it's $1.40 plus a 60-cent credit. And then from that, you work out what is the tax paid, which is $2 times 19%. And then, but because the company already pays 60 cents tax for you, so which means you owe them 38 cents, but the company pays 68 cents for you, which means essentially you're paying minus $0.22, which means if you're paying a minus amount, that becomes you will get paid. So that means in real life, that will be offsetting your other part of the income tax that you are receiving from your work or from your other sources of income. So in this case, essentially, you will get paid $1.62 after all the transaction. They may happen at different time point, but it's important for you to know that the effective tax rate is determined by your personal tax rate.
Yep. Excellent.
Okay, let's move on to question 3. Again, I'm going to share my screen to look at. So question 3 is pretty much the same thing. Repeat the previous question with the highest personal tax rate of 45%. So here we're going to give you another demonstration about how to consider when your personal tax rate is actually more than a company tax rate. So which means you end up paying more taxes then what the company can actually pay you back as a credit. All right, so everything back to where we start, that the companies give you $2 per share, and then company's tax rate is 30%. But the difference here is that your personal tax rate is 45%.
Yeah. So you can see that this question starts off in exactly the same way. There's no difference here. But when we come to calculate the amount of tax we should pay, well, our tax rate now is 45%. So the tax that essentially we should pay on the $2 earning per share is, or I shouldn't say $2 earning per share, I should say the grossed up amount between the dividend and the imputation credit is right? Which is 90 cents. So this is essentially saying, because we have a tax rate of 45%, we should be paying the tax office 90 cents per share in tax. Now you should notice straight away that, well, the company paid 30% in tax, which means the tax office really only received 60 cents per share, but you should be taxed at 45%, which means that you should be paying 90 cents per share. So when it comes to work out, well, how much tax should we actually be paying? Well, we can use our imputation tax credit and deduct that from the amount of tax that we ought to be paying. So what we end up getting here is, so the amount of tax, so I should say net amount, but amount of tax, it's really a net amount. So that is the amount that we are charged minus our imputation credit. So what does this 30 cents tell us, Frank?
That means you still owe tax office 30 cents. Here, given that is a positive amount, that means that's how much you owe them. You know, in a previous example, question 2, that number was negative. So that means if you owe tax office negative amount, that means tax office need to refund you that amount.
Yeah. So essentially, we need to give the tax office some more money because our personal tax rate of 45% is greater than that company's tax rate of 30%. So now we can go ahead and calculate. So essentially we owe the tax office 30 cents. We received $1.40 in our bank account from the dividend. So now we can work out what's left at the end of it. So what's essentially left in our bank account? So how should I write this? We are left with $1.40, right? So that's the $1.40 that the company gave us, minus the 30 cents, that we owe the tax office.
Yeah.
So what we're left with is $1.10. So how much tax is being paid? Again, it's the difference between what we're left with and what the original $2 or what the original earnings was. So the difference, so the amount, I should just say tax paid. The amount of tax paid is equal to our $2 per share minus our $1.10 that we had left over. So we've paid 90 cents in tax. And so our effective tax rate should be the same. So we just have our 90 cents that we paid in tax divided by the total $2, and that will give you 45%.
Which is not surprisingly your personal income tax rate.
Yeah. Excellent.
So as an extension, you may want to think about if that was a US C corporation, when there's a double tax system, what is the final amount you'll be receiving? So that can be extension that you can do in your own time. And if you have questions, please feel free to put it on the discussion forum.
Excellent. All right.
So now let's come to tutorial question number 4, chapter 1, problem 9. So why do all shareholders agree on the same goal for the financial manager?
So we talked about this when we really covered the principal agent problem and trying to align the incentives of people who own the company, the shareholders, and the people who run the company, the managers. And we're trying to align those incentives. And so we really need people to come up with some common goal, something that they're all trying to achieve. And well, I think it would be the majority of shareholders would agree that maximizing their wealth will make them better off, right? So that becomes a very common goal. That is the common goal for shareholders, and essentially they will, encourage, or I shouldn't say enforce, but they certainly want their managers of the company to maximize the wealth of the company.
But just like all other great things, that maximizing shareholder wealth is not clearly defined, or at least it's not universally defined, not universally agreed on. So, yep. I mean, we in the previous finishing of the lecture 1 video, we talked about something related to like other types of measures to measure the shareholder wealth in terms of like medium term to long term. So for example, if you think about from an environmental point of view, that is if the company's goal is to exploit the environment that they are operating in, and by not taking care of the sustainable use of the land or the material that they have, then that may not be an actual goal of maximizing shareholder wealth, because you may be looking into 40 years, 60 years. So it's actually maximizing shareholder wealth is not clearly defined.
Yeah, but we typically just use it because it would be common amongst most shareholders. Of course, there are people with different opinions and so on and so forth, but when we look at the majority of the ownership of a company, typically it's agreed upon that maximizing wealth is essentially the common goal, because it makes them better.
But let me just quickly ask you a question. Would maximizing profit and like equivalent to maximizing shareholder wealth?
I wouldn't say that they're equivalent, because I mean, what do you mean in terms of maximizing profit? Do you mean maximizing profit now, or do you mean foregoing profit now for profit in the future?
That's right. So the reason why I asked that question is because people tend to think about the more profit I have, the more money I have. Is that an equivalent way of saying that would be maximizing shareholder wealth? Or clearly in this case, you're not, because sometimes you, in a scenario where you foregoing the long-term benefit in exchange for the short-term profit, would that be maximizing shareholder wealth? Probably not. You would say, well, they will maximize some shareholder wealth if they only want to hold short-term. But for the majority of shareholders, you would tend to say, maybe on average, people want to tend to hold long-term. So on average, I want to maximizing longer-term profit rather than short-term profit. So again, that question is just trying to illustrate that it is not universally defined what you mean by maximizing shareholder wealth, but it's clearly not maximizing the manager's wealth, and not maximizing a single shareholder wealth.
Yeah.
And that will be completely violate the goal of the company.
Yeah. Excellent. So I think we can move on.
So now let's come to question all right, now let's come to tutorial question number 5, chapter 1, problem 13. You're the CEO of a company and you're considering entering into an agreement to have your company buying another company, like taking over. You think the price might be too high, but you will be the CEO of a combined much larger company. You know that when a company gets a lot bigger, you pay and prestige will increase. What is the nature of the agency conflict here, and how is it related to ethical considerations?
Well, so we're told a few things here. So one, we're told that this company wants to buy another company. And upon buying this company, it's going to become a larger company, one larger company. We've got two, and it becomes one larger company. Now, what it's saying is that you as the CEO, you might think, if I buy this company now, I might be paying too much for it. And so obviously that's not a good thing if you're paying too much for something, because essentially what we'll learn in later weeks is that when you're paying too much for something, well, then that's going to be reducing the value to your shareholders. So you might essentially pay $100 for something, and then that something might only ever return you $90, right? So you're worse off by $10. And so you wouldn't make that decision. You'd rather just hold on to the $100 and wait for something that will return you $110, right? Because then you have plus $10. So in this instance, we look at this and we say, well, this company might be priced too high. And if it's priced too high, then we would think that that's going to destroy value for our shareholders, because it's going to be destroying value for the firm. But here's the conflict, right? Is that the CEO looks at this and says, well, the amount of money that I get paid, so you're the CEO, the amount of money that you get paid is dependent on the size of the company. So what are a few ways that we could measure size, Frank?
Combined revenue, combined employees, and number of exactly, the asset, total asset.
Yeah, so like there are a number of different things that we could look at in terms of the size of this company, and so as those metrics grow larger because we've acquired another company, the CEO's compensation increases. So now you can start to see the conflict that exists between the people who own the company, the shareholders. They want to maximize their wealth, right? They want the company to be increasing in value, and the CEO who's sitting there thinking, well, if I acquire this company, it's going to destroy the value for shareholders, but I'm going to get paid more. So there's a conflict here. So there's a bit of an ethical dilemma when the CEO of a firm has the opposite incentives here. So I could get paid at the cost of destroying value of the shareholders.
Correct. And this question actually highlights the example that we just made in discussing question 4, which is the goal of the company is to maximizing shareholders' wealth, but not a certain proportion of shareholder wealth, because in this case, some may come and say, well, the CEO is buying another company, paying a much higher price than he should, but isn't that going to be benefiting the other segment of the shareholders? Which means when in a combined company, the original target, which is another company over here, their shareholders are going to be better off. Isn't that still doing the job, because someone's going to be happier? So remember, we're maximizing shareholders' wealth, but not a certain proportion. We want to maximizing every single shareholders in this scenario.
Yeah.
All right, now let's come to the last question. Here is the title. It's supposed to be tutorial question number 6, chapter 1, problem 18. So this is a question related to the share market. So the following quote on AMP Limited shares appeared on 5th of January 2016 on ComSec, which is about 4 years ago now. If you wanted to buy AMP Limited, what price would you pay? How much would you receive if you wanted to sell AMP Limited? So this question sort of really examines on your ability to looking at the limit order books, which is what we talk about here. If you look at the standing buyers and standing sellers. So in this case, if you want to buy AMP, are you going to the seller side or are you going to buyer side? If you want to buy it straight away,
I'm going to go to somebody who wants to sell me the shares.
Exactly. So in this case, that's right. So in this case, if you actually want to buy from someone, then that means you go over there and say, who is raising hand to say they want to sell? Well, in this case, there are a whole bunch of people who want to sell. There'll be people who want to sell at 521, 522, 523, and that's the corresponding amount of shares they want to be selling at. So here, assuming that you're rational, totally rational, that you'll be willing to pay at the lowest price, right? So that means in this case, if you're gonna buy, you'll be buying at 521. But if you want to sell shares to someone else, and you don't have the patience to do so, to do queuing up over here, and you want to sell it straight away, then you would go to the buyer side. In this case, you're going to go to the buyer side to say, who is buying? I can see someone's buying 41,000 shares at 520, and then 33,000 shares at 519. And again, being rational, Daniel, how much would you want to sell it for?
How much I would want to sell it for the best buy price, which is, sorry, I've got to look in. So $5.20 is what I would want to sell it for.
Well, being rational, you probably want to sell for a little higher than that, right? But in this case, given the amount of buyers orders that is available over there, the maximum amount of price, the highest price you can sell for will be 520. So in this case, as long as you're selling less than 41,459 shares, you'll be selling at 520.
Does that mean there is no right answer to your question?
That was just for fun. That was just for fun, right?
Sell it at $1 million. That's not rational enough. It's $1 billion.
Exactly. Oh, well, I mean, that concludes our tutorial talk. And we'll be seeing you in the next video talking about the week 2 lecture. And
financial analysis.
Yes, very important.